Hello InvTraXes. Managing your money is key to any successful trading strategy. It's not just about knowing which currencies to trade and when to enter and exit, but also about strategically allocating your resources and incorporating money management principles into your plan. Before jumping into the market, it's essential to consider factors such as position size, margin requirements, recent profits and losses, and a backup plan in case things don't go as expected. In short, smart money management is a must-have for any trader who wants to come out on top. When it comes to trading, it's important to keep your risk in check. Instead of going all in on a single trade, it's best to limit your risk to a small percentage of your total capital. A good rule of thumb is to only risk 1 to 3% on each trade. By doing so, you avoid the temptation to get greedy and stay focused on the process of trading, not just the potential payout. For example, if you have a $10,000 account balance, you should only be risking $100 to $300 on a single trade. This approach not only helps you manage your risk but also sets you up for long-term success in trading. When it comes to trading, it's not just about managing your risk, but also maximizing your potential rewards. A good rule of thumb is to look for trades that offer a profit potential that is at least twice the amount of risk you're taking on. Many traders aim for a profit potential that is 3 times their risk or more. For example, if you're risking $100 on a trade, you should be able to see a potential profit of at least $200. It's important to remember that if you lose 50% of your money, you'll have to make 100%, double your money, just to break even. So, managing your risk and seeking out high reward to risk ratio trades is crucial for long-term success in trading. Scaling is a technique used by many successful traders to enter and exit positions. It allows them to focus on the overall market trend rather than trying to pinpoint the perfect price level. There are a few different ways to scale, but one method is to enter a position gradually. This can have a big impact on your trading plan and help you stay flexible in fast-moving markets. By using scaling techniques, you can adjust your strategy based on market conditions, rather than being locked into a predetermined plan. This approach can help you capitalize on market movements and increase your chances of success. Pyramid scaling is a way to enter a trade by gradually increasing your position size as the market moves in your favor. Let's say you see a trade opportunity and believe it will bounce off a certain Fibonacci retracement line. To minimize risk, you decide to only place your entry order near the line and risk only 1% of your capital to start. If the market goes in your favor and reaches your target, you can scale in by adding more positions and increasing your overall trade risk up to 3%. This approach allows you to take advantage of market movements and increase your potential profit while minimizing risk. However, it is important to remember that scaling does not give you a free pass to ignore other money management rules. Scaling should be used in conjunction with other risk management strategies, such as setting stop loss and profit-taking levels. It can also be used for exiting positions by taking profits at predetermined levels and using a trailing stop to capture additional profit if the market continues to move in your favor. If you learned something valuable from this video, don't forget to subscribe to our YouTube channel and liking the video. Follow our Facebook page as well for more useful content if you're watching on Facebook. Want to get free trading signals? Then join our Telegram channel now. See you again.